Okay, folks, so we got to give a violent update on the market and plays, including one play that just exploded today, finally. One that was up over 50% at highs. What is my price prediction on this moving forward? And why are the Czech people so happy? And then lastly, number 2, I want to talk about the latest with this EV euphoria. When is the right time to take profits on Lucid? And what is this new catalyst that's coming tomorrow for a different EV company? And the only thing that I ask before we get into all of this is that you hit that ravishing like button, and also don't forget to subscribe either. Okay, folks, so fairly risk-on day. You had a very slow start, and then all of a sudden, capital started flowing. We'll start with some of the bad or more fuddy news first. Mara, lovely Mara, and Riot holding up pretty damn well today despite a lot of the new FUD in the sector and despite Bitcoin sell-off. Mara specifically not only is dealing with that new subpoena request, but is also expanding her debt offering. D.A. Davidson reiterated their buy rating on the company to their clients, saying that the sell-off was overdone. Quote, "We don't see much risk around the potential securities violation and would use any further weakness as a buying opportunity." I agree with them. The actual result of the subpoena request is probably nothing or small. But in the short term, I wouldn't underestimate the amount of people who buy this just because it's going up and have no idea what crypto miners are or what they really do behind the surface level details. There's a lot of people that probably bought this thinking that it was going to be a consistent uptrend or not looking at the previous chart on what it's done even in the last 12 months. And the minute that it has a broader sell-off or a broader crypto winter, you're going to see huge panics, which is excellent for people who have that expectation, but is bad for people who are caught off guard. I see it as my job to say, hey, Mara, she can please, but she can also tease big. And we've dealt with that over and over again this year. So I would say, be alert. Over the last 2 months, this has been an insanely profitable sector, and that comes and goes. If it was just constant profit, then anybody could do it. But in terms of cycles, this certainly isn't the year for foreign market e-commerce. Jumia holding up like a bat in a bat fire on earnings despite pretty strong user growth. Growing into new markets is challenging and expensive and very difficult, and the market just hasn't wanted to take that risk like it had a couple quarters ago, and especially in 2020. But at the same time, I don't think that emerging markets should be overlooked. You give some of the top players in these markets time to actually grow into the markets and actually do what they're setting out to do, and I think that you're going to be surprised at the outcome. That said, as somebody who's believed in stocks like NEO since like $3 or $4 a share, NEO went down for like 19 months when I started liking it. And once again, NEO itself is in another stagnation period. So, I mean, at the end of the day, emerging markets aren't for everybody, but I think that if you have a long enough time horizon and you have patience and you get the right capital environment, well, you do tend to get rewarded more than not. But anyways, moving into good news, the big play today was PROG. So full context, PROG has been a short squeeze candidate play that we've liked on social sentiment-based hype since September 14th. On September 14th, they had earned an important patent, and the low cap nature and higher media attention, I thought, may lead to having further reactions. And then over time, we started realizing, hey, this is a huge short squeeze candidate. And it had an overall pump up uptrend going from around that point at 90 cents to as high as 646. It then had a cool down, and now it's back on another pump cycle. Yesterday's briefing, my thought process was retaining high levels of social media attention despite not moving much. Does this suggest an impending breakout this week when you have a massive inflow of people mentioning a stock, especially one with a previous pattern like this with massive short interest? Well, what happens? Well, eventually you're going to start seeing those inflows. That breakout actually happened earlier than expected. It went from 3 to 3.5 yesterday on highs and then continued into the after hours and pre-market. This morning, I reiterated it. Continues second day of running after yesterday's briefing, emphasizing healthy social media mention uptrend. And obviously today it really took off. But so far it has been following the overall pattern we've come to expect since September. Shorts think this is absolutely worth nothing. And if you look at failures to deliver in yellow, you could see some alleged symptoms of naked short selling. Remember, when you fail to deliver, what happens? Well, you're artificially selling shares that you don't actually have the right to sell, which is creating artificial selling power and suppressing the price, artificially screwing the massive retail base that's buying this. Of course, though, in this new market environment, retail traders know that, so what they do is they try to make that backfire on short sellers by going and buying it and forcing them to be deeper in red than they otherwise would have if they just borrowed the shares that they actually had the right to borrow. It's also true that an SEC filing signed November 15th shows that the CEO of PROG just bought 2,086,000 shares of common stock at a price of $3.54, which has helped bolster the enthusiasm for the stock. That said, I think today was a lot more whale driven. You have whales trying to squeeze out their competitor whales that are short this and anticipating retail buying in after them as well. I think in this case, retail started it and then whales pushed it over the edge and then retail continued buying in after them. But I think that understanding that is crucial because when this stays up at these high prices, it creates a massive risk to the overall risk profile of somebody who's short this or to somebody who's executing options on this. Now, in terms of my predictions on whether this is going to run more, well, my take is that this is a much stronger rally than we had in that short blip to 646 a couple weeks ago. It's collecting buyers, and buyers are anticipating a gamma squeeze and a heightening of pressure on short sellers. If it continues going at this pace without mass profit locking in, I'd argue it has a much higher chance this time around of breaking out exponentially than it did last time it broke out. Kind of have that dilemma where if the crowd stays in, it creates this massive opportunity for a much higher squeeze potential, but if the crowd decides to take profits, well, all of a sudden that squeeze potential goes down dramatically. And obviously the risk versus reward depends on your own entry price. But in terms of the chart, the reason that I've continued to cover PROG on the briefings and on the channel to some extent is because it's continued to make higher and higher lows. Which means what? It means retaining power. The key of a social sentiment play, especially a squeezer, is its ability to retain value and fight off short selling. At the same time, each retaining low has resulted in higher and higher highs. If that pattern continues, it could certainly be set to break out past 646. But make no mistake, plain and simple, at the end of the day, right now, the biggest driver of this is going to be whether it continues to pick up that retail meme momentum. Because if it does, you're going to start seeing a lot of the pressure increase dramatically on shorts with this. And first and foremost, obviously driven by the options chain. We got to get those gamma squeezes. So at the end of the day, I would say make sure that you're locking in profits and tightening your risk management along the way. Let everybody else that's buying in after you take on the risks of the position and just sit on house's money. And if you are a ZipTrader, remember, make sure to check in with us 30 minutes prior to market open tomorrow morning for the daily morning briefing, and I'll give you an update on what my latest take is based on the pre-market setup and what other plays I see. Okay, next, the Lucinator, continuing to see huge buys as people get excited about demand and production. Now, from a fundamental standpoint, obviously, you're getting into that range where you're starting to price in 2024 sales post the introduction of their Gravity SUV, and of course, 2 years of scaling up into 49,000 deliveries. But from a technical standpoint, we've been here before. My thought process at the beginning of the year when we called out its SPAC CCIV at just under $15 a share was that, hey, I see the mere speculation of CCIV and Lucid merging as something that's going to rally this up as high as 30. We made a strong argument for this as a trade, and then longer term after you see the original dip as a massive value play. But anyways, it went a lot farther than we had expected. It went all the way up to 60. And then they switched up the deal a bit to make it worse for CCIV SPAC holders. The hype died off a lot, and then the growth cycle tanked it. And then we made arguments for post-merger Lucid pretty much all year, but it did nothing. And then all of a sudden, within the last couple of months, it's almost quadrupled. But what's ironic is that you're now well on your way back to those prior hyped up highs back when Lucid was still CCIV. But this time around, you don't have the same level of risk of merger talks falling through, nor do you have risks of merger details switching at the last minute and screwing SPAC holders. And from a TA standpoint, the momentum's looking pretty damn hot. But at the same time, from a fundamental standpoint, the company is over-factoring in its success in the upcoming years. Now, any trader will tell you it doesn't really matter if something's going up too far too fast because it can just keep going up because the market, when it's in the right cycle, can reward something way more than it deserves, and it can also beat something down way more than it deserves. But you have to have something that ties together both worlds. My take is just have tighter and tighter risk management as it factors in more and more years of growth. Tighter risk management and strategic profit taking can be very powerful on this, and the reason is because you can lock in this euphoria, and then when the euphoria dies off, you can then go and use that same capital to go and dip buy Lucid. My take is I'm very happy to see Lucid rallying so much after such a long period. I think like 3 quarters of having to deal with Lucid is a bag holding position. This is a terrible stock. All of a sudden it's like, hey, no, this is actually a great company. But at the same time, you don't want to create the next generation of people who buy in at all-time highs and then decide when it's all at all-time lows again that it's a terrible stock because they played the cycles incorrectly. So something to think about. Okay, speaking of euphoria, Rivian. Rivian is now the 3rd most valuable car maker on the planet despite having $0 in revenue in the last report. If you look at the stack-ups, you see Tesla at number 1, Toyota number 2, Rivian number 3, and Volkswagen at number 4. Lucid is already at number 8 as well. It's funny because back in the day, Tesla was so heavily attacked for not having the same level of deliveries and overall production capacity as a lot of the other players on this list. And Wall Street was like, I'm not going to touch that with a 5-mile stick. I'm going to short the hell out of it. And that didn't work out for them so well. And now they're going and plowing tons and tons of money. You see all these big institutional players plowing lots and lots of money into these stocks, which we already like, and I'm not complaining about it, but it's just funny to see how the turntables. But anyways, don't be fooled. A lot of Wall Street's money that's flying into Rivian right now isn't going to stay until 2030 to realize its gains. It's already factored in most of the next 10 years of sales. These momentum traders aren't long-term traders. They're I want to play hype traders. I love Rivian, but like I said, when nobody wanted to buy EV stocks because they're big scams and Jerome Powell is going to end the EV industry, time to buy it is when no one believes in them, not when everybody believes in them, and they're believing them to an extent that doesn't even make sense. Once the positive PR stops and a lot of those hedge fund momentum traders stop buying it, well, you're going to see reasonable valuations and dip days. And lastly, a catalyst to prepare for, FSR Fisker. Fisker has continued its uptrend ahead of its Ocean SUV reveal tomorrow. We talked about this one Sunday, but essentially this gives Fisker an opportunity to give analysts a look at its much anticipated SUV, which should start delivering at the end of next year. I will be watching tomorrow and hopefully it gets some solid media coverage. With delivery starting a ways away, though it's going to be a long battle for the stock, but both hype traders and long-term holders should be excited. In a Rivian-driven SUV world, a new EV SUV competitor is certainly going to turn some heads. Anyways, folks, that caps off the video. If you have any questions, feel free to reach out to us below or join us on ZipTrader Circle. If you'd like to learn how to trade with our step-by-step lessons, our private chat, and of course our daily morning briefings, well, I'll go ahead and put a link to ZipTrader you below. Of course, we do have that $100 off Black Friday 100 coupon code discount, so if you are interested, this might be the time to do it. So go ahead and check us out below. We got a video that walks you through the course and what we offer. Anyways, that caps off the video. Have a good one. I'll see you in the next one.